Hello everyone, I'm Ankur Chaudhary from Hitbullseye.com, and this is the third and the final lecture on financial systems in India. So let us try and understand what are exchange platforms. So it is a marketplace in which securities, commodities, derivatives and other financial instruments are traded. Now exchange platforms can exist both in the real as well as the virtual world. So as far as the virtual world is concerned, most of the exchange is done in the electronic or digital form through DMAT or dematerialized accounts today. The various functions performed by exchange platforms are to ensure fair and orderly trading of various securities. In order to ensure this, they have to function under the regulation of various bodies like SEBI, RBI, etc. Next is efficient dissemination of price information. Now this is very important as far as any exchange platform is concerned, that the correct price is reflected or passed on to everyone in the market. Now with the advent of DMAT account and electronic trading, again this task has become very easy. The various examples of domestic exchanges in the country are BSE, that is the Bombay Stock Exchange, NSE, National Stock Exchange, and OTCI, that is the over-the-counter exchange of India. As far as international exchanges are concerned, some of the prominent ones are NASDAQ, that is the stock exchange in USA, as well as LSE, that is London Stock Exchange in Britain. Next we talk about the functions performed by financial institutions. Financial institutions act as intermediaries which facilitate smooth functioning of the financial system by making investors and borrowers meet. So they act as an interface on a connecting point between investors and various borrowers. Also, they provide services to entities seeking advices on various issues ranging from restructuring to diversification plans. So beyond acting as an interface or a connecting point between investors and borrowers, financial institutions also provide certain advisory services. For example, restructuring. If a company is not able to repay back its loan, the loan conditions will be restructured. For example, the period of payment might be extended or the rate of interest might be lowered. And further, diversification plans. So this involves diversification of portfolio, whether a company or an individual should invest his money in stocks or bonds. Also, they act as middlemen between savers and borrowers. So the various types of financial institutions are All India Financial Institutions or AIFIs. So institutions like NABARD, SEBI, etc. They are regulatory All India Financial Institutions. Furthermore, there are other institutions like IFCI, IDBI, etc. which are other types of financial institutions. Then there are certain state level financial institutions which function at the level of different states in the country. Then there are other or local level financial institutions in the country. Further, all India financial institutions are divided in various categories. So there are all India development banks. So for example, NABARD. Again, you have various investment institutions, refinance institutions. For example, the recently introduced Mudra Bank is a refinance institution. There are certain specialized financial institutions which are functioning or which are catering to the financial needs of specific sector, like the power sector. So example that you can take over here is Power Finance Corporation or PFC, and there are certain other financial institutions as well. When you talk about the state level financial institutions, there are state finance corporations which provide loans for within the state for specific purposes. Furthermore, there are state industrial development corporations which provide loans and advisory services to develop industry within the state. Now at the national level, there are certain other financial institutions as well. So first one is Export Credit Guarantee Corporation of India. It was founded in the year of 1957 and it is under the Ministry of Commerce. So what ECGC does is, ECGC provides insurance as well as loans to exporters of the country. Next we have is the DICGC, that is Deposit Insurance Credit Guarantee Corporation of India. It was established in the year 1978 and is currently functioning as a subsidiary of RBI. So major function of DICGC is it ensures all the deposits that are made in the bank which are of values less than 1 lakh rupees. So whether they be current accounts, fixed deposits, saving account, etc., all these accounts of less than 1 lakh rupee is insured by DICGC. Next we take a look at a category of financial institution called the NPFC, that is non-banking financial company. It is a financial institution that provides banking services but does not hold a banking license. So what this means is that NBFCs cannot accept deposits like other banks. However, there are certain categories of financial institutions that are not included in NBFCs. So NBFC do not include any institution whose principal business is agricultural activity, industrial activity, trading, or sale or purchase construction of immovable property. So the main regulating body for NBFC in the country is the Reserve Bank of India, right? So RBI regulates NBFCs which are into the business of lending, acquisition of shares, stocks, bonds, etc., or financial leasing or hire purchase. The next important concept within the financial sector in the country is financial instrument. So financial instrument is any claim against a person or any institution for payment at a future date of a sum of money and or a periodic payment in the form of interest or dividend, right? So it is any financial claim against an individual or a company. So this can be in the form of shares, bonds, etc. So financial instruments like shares and bonds are marketable and tradable in the primary market as well as the secondary market. So as we saw in the earlier lecture, if a company wants to raise new equity, it will do so in the primary market in the form of initial public offering or IPO. Furthermore, these financial instruments like shares can be traded in the secondary market like stock exchanges. So examples include bonds, debentures, etc. So the various types of financial institutions that we have discussed, they are involved in providing financial services like borrowing and funding, lending and investing, buying and selling of securities, payments and settlement, and managing risk exposures in the financial market. So financial institutions earn money by providing these services. So examples include credit rating. So various credit rating agencies in the country exist which provide a credit rating to various corporations or companies in India. On the basis of these ratings, the rate of interest at which these companies can borrow is decided. Leasing as well as hire purchase. Now let us take a look at the different financial regulators operating in the Indian market. Now these financial regulators regulate the functioning of financial system in the country. They make rules on how the financial systems or banking or other financial institutions should work. They monitor their functioning and also they might penalize in case they break any rules. So the major institutions can be classified under two broad categories. So first are statutory bodies. Now a statutory body is any body which is created by law in the country. So first and foremost is the Reserve Bank of India or the RBI. Now, RBI is the apex body controlling the functioning of financial system in the country. RBI is empowered to create further new organizations or delegate some of its power to new organizations. However, it does remain the apex or the primary regulator of financial system in the country. Next is SEBI or Security and Exchanges Board of India. It is mainly concerned with regulating the stock markets in the country. Furthermore, we have IRDA, and it is the primary body regulating the companies which are offering insurance related products in India. There are other bodies which are functioning under different ministries in the country. So first is FMC, that is Forwards Market Commission. So this is the primary regulator as far as derivatives market in India are concerned. So it was earlier functioning under the Ministry of Consumer Affairs, Food and Public Distribution. However, recently it has been merged under SEBI and is autonomous today. Next is an organization called PFRDA, that is Pension Funds Regulatory and Development Agency. So this is an organization which is managing all the funds which are collected under the various pension schemes of the government, and it is functioning directly under the Ministry of Finance of the Union government. So in the year 2011, a very important committee was formed by the Government of India called the FSLRC. FSLRC stands for Financial Sector Legislative Reforms Committee. This particular committee was headed by Justice B.N. Shri Krishna, a former or a retired judge of the Supreme Court of India. Right? So this particular committee was formed by Government of India to examine the regulatory structure and laws governing the financial sector of India. So basically the idea was how to make the financial sector better by introducing reforms or new laws in the financial sector. The Shri Krishna Committee gave very far-reaching recommendations with regard to reforms of the financial sector. So it said that there should be a single regulator called Unified Financial Agency, which should be regulating the whole financial sector of the country. So IRDA, PFRDA, etc. would be subsumed under single organization called the Unified Financial Agency. Next, Justice B.N. Krishna recommended that another body, that is Financial Redressal Agency, FRA, should be formed. This should be a single agency in which all the complaints related to financial systems should be registered. Now, as far as Financial Redressal Agency is concerned, all the complaints are to be registered with FRA. However, if the banks want to contest any particular complaint, then the appropriate authority to decide on the complaint would be the Financial Sector Appellate Tribunal, or the FSAT. Furthermore, Shri Krishna Committee also recommended formation of other 3 minor regulatory agencies. The recommendations of the Shri Krishna Committee came under a lot of debate because it recommended that the powers of Reserve Bank of India should be limited only to monetary policy making, and all the other regulatory powers should be transferred to the Unified Financial Agency. So that brings me to the end of this particular video lecture. So in this video lecture, we studied the different important components or terms related to financial systems. For example, the exchange platforms, financial regulators, financial instruments, financial services, and in the end, we also saw certain major recommendations made by the FSLRC. Thank you very much.